All right, let's just get right into it. You've heard it a million times, right? Renting is just throwing money away. The smartest thing you can do with your money is to buy a house and build that sweet, sweet equity. But what if, and just hear me out, what if that advice isn't just a little off? What if it's completely catastrophically wrong? Today, we're going to challenge that entire idea using nothing but some simple and honestly undeniable math.
So let's talk about a guy named Jason, and I bet his story is going to sound super familiar. He's 28, and he did the thing you're supposed to do. He bought a house. You know the pressure. He was tired of paying rent, his parents kept asking about his future, and he'd worked hard to save up a down payment. He really felt like he was making the big, smart, adult financial move.
And then, reality hits. The first shock to the system. His monthly costs just exploded. He went from a pretty manageable $1,900 a month in rent to almost $3,300 for his new mortgage, taxes, insurance, you name it. I mean, think about that jump. That is a huge new financial weight on his shoulders every single month, all in the name of building equity.
So he grits his teeth and sticks with it for 4 years because, it's an investment. It's supposed to pay off. But here's where it gets really interesting. When you actually stop and run the cold hard numbers on his decision, a totally different story starts to unfold. A much, much more expensive one.
Okay, now this is the slide that just blows my mind. After 4 years, yeah, Jason has 93 grand in home equity. That sounds pretty good, right? But hold on. If he had just stayed put in his old apartment and invested the difference, all that extra cash he was now spending, he'd have $138,000 liquid in an investment account. Let that sink in. He is $45,000 poorer because he bought the house. He didn't build wealth. Compared to the alternative, he actually lost it.
So this gets to the heart of the problem, right? The entire decision was built on a lie, a fundamental lie. This whole idea that every single dollar you pay in rent vanishes into thin air, while every mortgage dollar is a little golden brick in your financial castle. It is probably the biggest myth in all of personal finance, and we're about to tear it apart.
So how do you cut through all the noise, all the emotion and family pressure? You need a tool. Something simple, a back-of-the-napkin calculator that gives you the real, unbiased answer for your specific situation. And that tool is the 5% rule.
What the 5% rule does is actually pretty genius. It's designed to find one single crucial number, the point where the money you throw away on owning a home is the exact same as the money you throw away on rent. Because, and this is the key, owning a home has tons of costs that you never ever get back. Money that just poof, gone. Just like a rent check.
So what are these unrecoverable costs? Well, they're pretty simple. You've got 3 big ones. First, property tax. That's about 1% of your home's value every year. You never see that money again. Second, maintenance. The leaky faucet, the new roof, that's another 1%, on average. Gone. And the third one, the biggie, is cost of capital. That's all the mortgage interest you pay, plus the returns your down payment could have been making in the stock market. That's about 3%. You add them up, 1 plus 1 plus 3, and there you have it. 5% of your home's value every single year is money you're throwing away as an owner.
Okay, so that's the theory. Now let's have some fun with it. Let's put this rule into action and see what it tells us about some actual housing markets across the country.
Seriously, the math is so easy. Let's say you're looking at a $500,000 house. Okay, take 5% of that. Boom, that's 25 grand. That's your unrecoverable cost of owning for the year. Divide that by 12 months, and you get, what, just over $2,000 a month. $2,083 to be exact. That is your magic number, your break-even rent. If you can rent a similar house for less than that, financially, you should rent. It is that simple.
And check this out, when we use real data. Look at San Francisco. The rule says buying only makes sense if rent is over $5,000 a month. But the actual rent is way down at $3,200. It's a no-brainer. You rent. Austin, same story. Renting is clearly cheaper. But then, look at Cleveland. The break-even rent is under $1,000, but the actual rent is higher. So in a place like Cleveland, buying actually can be the smarter move. See? It's not a one-size-fits-all answer. It's totally local.
Okay, I can practically hear you shouting at the screen right now. But what about appreciation? My house is going to go up in value and make all this worth it. This is the #1 counter-argument, the ace in the hole for homeownership. So let's actually look at the data, shall we?
Pay attention, because this might be the single most important number we talk about today. A Nobel Prize winner, Robert Shiller, looked at over 100 years of data. And you know what he found? The average real return on housing, that's after you account for inflation, is about 1%.
a year. Let me say that again. Not 8%, not 5%, 1%.
And this chart just makes it painfully clear. Housing, at 1%, is barely beating inflation. It's basically an expensive savings account. Meanwhile, the stock market? A real return of around 7%. That's the opportunity cost. Every single dollar you have tied up in your house is a dollar that's not growing at 7%. And that difference, compounded over decades, it is absolutely life-changing.
And just when you thought it couldn't get any worse for the buying is always better argument, there's more. You see that 5% rule we've been using? It's actually being nice. It's often a conservative estimate. There are other giant hidden costs that can make the financial case for renting even stronger.
Let's just quickly touch on the big three that catch almost every new homeowner completely by surprise. First, the insane cost to sell your house. Second, what I like to call maintenance volatility. And third, the true crushing opportunity cost of that down payment. First up, transaction costs. When you go to sell that $500,000 house, you can expect to just hand over 30 to 40 grand to real estate agents and for closing costs. That money doesn't go in your pocket. It just evaporates. It's gone forever. If your house only went up by 40 grand in value, you literally made nothing.
Next, maintenance. It's not this nice, steady 1% a year. No way. It's chaos. You'll have a few good years with nothing, and then bam! The roof starts leaking, the AC unit dies in July, and the water heater floods the basement. All at once. That can easily be a $30,000 bill out of nowhere. As a renter, you just make one phone call. It's not your problem.
And finally, let's go back to that down payment. You have to stop thinking of it as an investment in your house. It's cash that is trapped by your house. It's a huge pile of your money that's now stuck earning that pathetic 1% real return we just talked about, instead of the 7% it could have been getting in a simple index fund. The math on that difference over time, it's just brutal.
Okay, I know this has been a lot, and it might sound like I'm saying you should never, ever buy a house. But that's not it at all. The whole point of this is to throw out the old, broken narrative and give you a new, smarter framework to work with, so you can figure out when buying actually is the right move for you. So here it is, your new playbook, your 5-step checklist. 1. Find a home you would realistically buy. 2. Calculate its 5% break-even rent. 3. Compare that number to what you'd actually pay to rent a similar place. 4. And this is a big one, be brutally honest with yourself. Are you positive you'll stay put for at least 7 to 10 years to make up for those transaction costs? And 5. Run the numbers, just like we did for Jason. See for yourself which path actually builds more wealth.
So at the end of the day, we have to completely reframe how we think about this. Renting is not throwing money away. Let's just banish that phrase forever. Rent is the maximum you will pay for housing in a month. Owning is the minimum. They are both just ways of paying for shelter. Owning just comes with a totally different and frankly, way more complicated set of costs.
And that leaves us with one final question. When it comes to one of the biggest financial decisions of your entire life, are you going to let your choice be guided by the numbers and the data? Or are you going to let it be guided by a cultural narrative that, as we've just seen, often doesn't stand up to the math? The choice is yours.